Hey, welcome back. I'm glad you're here for this one because today we're going to go into the jungle, the legal, financial, slightly terrifying jungle known as the term sheet. Because this is going to be somewhat intense, I think it's fair to break it down into a few parts. So, in segment one, we will chat about what a term sheet actually is and why the non binding label is so misleading. In segments two and three, we will frame the two master categories of the document, namely control and economics, before diving into each major clause. The clauses will be in segments 4 to 8, as this is for both the entrepreneur as well as junior capital allocators freshly minted and looking at term sheets. I will try to do everything from a dual lens perspective. Therefore, speaking about what the VC wants and what the founder needs to watch out for. In the final segment, we will wrap it all up. I hope this is not too much. It's going to be quite a long episode. And all the lessons that I've received over 5 years of practice and participation in deals, a number of books that I have read, and advice I've gotten from lawyers. And I hope all of that I'm able to convey to you and help you on your journey. So happy listening. I hope this episode enriches your knowledge base, helps you prepare for negotiations ahead, and makes you successful all in all. I am your host, Yongama Skweia. Welcome once again to Confessions of a Recovering Entrepreneur, or the Core Podcast, where we pride ourselves in being a platform where we bypass the hype and the highlight reels of venturing so overrepresented on social media and getting to the heart or the core of what is happening. And it's very important that we build something meaningful with you. And we thank you for once again coming on this journey with us. And today we're going to walk through the most important elements of a term sheet one by one. And I'm going to tell you what each one means from a VC perspective and what each one means for you, the entrepreneur. Because these two perspectives are often wildly different for various reasons. As great as it is that they are relationships that are built between entrepreneurs and investors, at the end of the day, you are separate parties. And in certain situations, you will find yourself in conflict because of that difference. So, what is a term sheet really? First, the basics. A term sheet is a non-binding document, usually that outlines the key terms and conditions of a proposed investment. Think of it as a blueprint before the architects actually start drawing. It's non-binding in the sense that neither party is legally obligated to complete the deal just because they signed it. But here's the thing. On a psychological perspective, it is quite binding. Once you shake your hand on a term sheet, walking away gets complicated very fast. Momentum, legal fees already spent, relationships on the line, all of that creates pressure and to close and actually follow through with the so-called non-binding elements of that document. So treat every clause like it matters, because once the lawyers start turning the term sheet into a definitive document, these terms become very, very, very real. There are really two broad categories in terms of any term sheet. It's the economic terms, which essentially refer to who gets the money, and the control terms, which stipulate who gets the power. These are not interchangeable, and each one you need to be represented either as an investor or as uh, an entrepreneur. So it's very important that one looks at both areas. But the essential thing about a term sheet is to look at economics as well as control. We are going to do both in this episode, and I want you to hold that distinction in your mind as we go along, because most of the tension in a negotiation lives right at the boundary. So let's start with control. Control is the thing nobody talks enough about until it's too late. When an investor in your company comes to you, they are buying equity. They are exchanging their paper for your paper. Their paper is the cash, your paper is the shares. But equity alone doesn't tell the whole story. What really matters is who makes the decision, who has the power to hire and fire the CEO, who can approve a sale of a company, and who decides whether you raise another round or not. Control in a term sheet shows up in a few different ways. You've got board composition in terms of who sits on the board and gets a vote. You get voting rights. Whether certain shares carry extra votes is also something that we can look into. And you've got protective provisions, which we'll talk, I think we'll come back to that in a moment because they deserve their own spotlight. And here is how the two sides will see control. From the investor side or from the VC side, control is about risk management. Think about it. When you write a check for 5, 10, or $20 million rands or renminbis, you want to make sure that the person spending the money isn't going to do something reckless without at least having to answer to someone. A board seat thus gives the investor visibility and purview to the operations of the business, where we'll be able to see what's happening from an investor perspective. Furthermore, they get voting rights, which gives them leverage. And it's not about distrust. Well, humans will be humans. Rather, put systems in place to ensure we are all on our best behavior, and more importantly, have full accountability. And therefore, you need to have these terms in there. Now, from an entrepreneur's perspective, control is existential. You build this business. You've had the vision from day one. Giving up control doesn't just feel personal, it is personal. And there's a real practical concern too. Matters like losing control of your board, you can lose your job, of which we know too many such stories. Founders getting fired. It happens more than people want to admit. If you take an example of Mark Zuckerberg of Facebook fame, he structured Facebook shares specifically so he could never be removed. That wasn't an accident. That was built in to the term sheet with his investors. So, all in all, the key things to watch in a term sheet around control are, firstly, how many board seats does the investor get versus the founders? Secondly, is there a mutual consent requirement for certain decisions to be made? And lastly, are they weighted voting shares that give the investor outsized influence even with a minority stake? I would advise any entrepreneur to ensure that investors coming in to your business do not in any way get majority board control. This, if you allow it, is the beginning of the end for you. Investors essentially should exist to support founders, providing much needed financial capital social capital in terms of contacts, connections, and access to opportunities and mentorships. And lastly, sweat capital by being able to help the founding teams strategize and at times execute their mandate and strategy. Other than that, no investor should have majority control in a business that they are investors in and not intend to own it outright. And that is a conversation for another time. As an entrepreneur, if you hand over the keys to your venture early and with multiple rounds still ahead of you, the dilution of your control will only compound. Where you will find yourself as merely an employee to a venture you founded with little to no equity to speak of, and more importantly, limited upside at a future liquidity event. So, negotiate hard and make sure that you have control. Board composition is one of the few terms that doesn't have a rand or a dollar amount attached to it, but makes it easy to overlook. So do not overlook it. All right, let's now talk money. The economics section in a term sheet answers one fundamental question, which is when there's money to distribute or liquidity events to happen, who gets what? The headline number, which is the valuation, is what everyone focuses on in the press. Let's take an example. If a startup raises $50 million, for argument's sake, in this instance, the valuation is almost meaningless without understanding the structure of the deal. Two companies can raise at the same valuation and end up completely different outcomes for founders, depending on the terms within their term sheet. Economics show up in a few ways: the pre-money valuation, the size of the round, and the option pool shuffle. Liquidation preferences, convertible preference shares, and redemptive rights. But for now, here's something to think about. The investor, usually a venture capitalist, is trying to maximize their return across a portfolio of companies, knowing most will not succeed. On the other hand, the entrepreneur is trying to maximize their return from this one company, which they've poured their life into. These two incentives look similar, but they diverge meaningfully in down scenarios and moderate exits, as well as in edge cases, which is exactly what term sheet clauses are written to address. So let's dig into specific provisions one by one. The liquidation preferences. This is the one. If you only pay attention to one economic clause in the term sheet, make it this one. A liquidation preference determines who gets paid first and how much when a liquidation event occurs. That's a sale of a company, a merger, and in really great situations, an IPO. Basically, any time the company's assets or equity changes hands. What all this means is, in non-legalese language, let's say an investor invests $10 million in a startup. The liquidation preference says that before any other shareholder gets paid, including the founder, the investor gets their $10 million back. That's a 1x liquidation preference. It's a form of protection against the high risk and unknown potential of a VC investment. The investor is basically saying, I want my money back first if things go sideways. Now, let's get into some more complicated subclauses, specifically participating preference or preferred liquidation versus non-participating preferred liquidation preferences. With non-participating preferred, the investor makes a choice at exit. Either they take their liquidation preference, as indicated earlier, or they convert that to ordinary shares to take their pro rata shares of the proceeds. Or they can just do both. With participating preferred, sometimes called double dipping, and the name will make it apparent very soon, the investor gets their money back first and then participates in the remaining proceeds alongside ordinary shareholders. Maybe in future, I will make an episode that delves into the kind of ownership structures available, as well as the different tiers of shares or stock that is available in a venture. But for now, we'll just look at these on a superficial basis. Now, getting back to participating preferred, the investor gets paid twice. In a strong exit, this can dramatically reduce what founders and employees walk away with. Let me give you a concrete example to illustrate all of this. Say again, your company sells for 30 million. The investor, as indicated, put in 10 million at 1x participating preference and owns 40% of the company. Under non-participating, the investor takes 12 million, which is 40% of the 30 million that the company has been sold for. The founders and the others split a balance of the 18 million, which is 30 million minus the 12 million that the investor takes, which is 18 million. But under participating preferred, the investor takes back the 10 million first, which is the preference that they have. But remember, they own 40% of the business. So at 30 million minus the 10 million that they've taken because that was their preference, they owe then what's left over is 20 million. And because they own 40% of that 20 million, it allows them to have a further payout of 8 million. Therefore, the total payout to the investor is now 18 million. The 10 that they took out first, as well as the participating 40%, which is the 8 million, gives you the 18 million. And then the founders and everyone else have to split 12 million. Same deal, same numbers, very different outcomes. Some term sheets have multiple liquidation preferences. Unlike the example I made, which I based on 1x, they could be 2x or even 3x, meaning that the investor gets 2 to 3 times the investment back before anyone else sees a dollar, rand, or renminbi from the business. These are more common during certain market cycles, but they do appear especially in distressed rounds. What I would like everyone to get out of this is that liquidity preferences are great strategies to protect against the potential downside that may happen in future. After all, venturing is about going forth without knowing what the future looks like. For the investor, liquidation preferences are downside protection. If the company doesn't hit the returns they modeled, at least they get their capital back before founders see a cent. It's rational. It needs to be kept in mind The money from venture capitalists do not belong to them in their personal capacity. They are merely stewards of the capital. They need to invest it in on behalf of their limited partners in opportunities that have potential to have a great upside, where they have quantified and understood the risk in order for it to be a viable investment opportunity. Now, for the entrepreneur, liquidation preferences can hollow out an exit that feels like a win on paper. Fight for non-participating preferred. It's the most founder-friendly version, and it's become more standard in competitive markets. If you can't get non-participating, push for a cap on participation, meaning investors participate up to, say, 2x the investment, and then ordinary shareholders take the rest. It's a compromise, but it limits the damage that can come from not having that in place.
Protective provisions, sometimes called veto rights, are a list of actions the company cannot take without the approval of the preferred shareholders. In plain English, things you cannot do without asking your investors for permission. The list typically includes things like issuing of new shares, selling the company outrightly, taking on significant debt, changing the company's charter, paying dividends, and liquidating the business. For the investor, these are guardrails. They prevent founders from doing something drastic, things like taking on crushing debt, selling to a competitor for a low-ball offer, issuing of many new shares that the investor's stake gets washed down or diluted completely. It's a check on unilateral founder power. For the entrepreneur, however, the danger of protective provisions isn't the list. Most of those things should require investors' sign-off. The danger is breadth and threshold. Watch for provisions that require constant approval for operational decisions, be it approving annual budgets, hiring of executives, or entering into material contracts. If every significant business decision requires investor approval, you're not running a company. You are merely an employee with some equity. And for many entrepreneurs, this is not the ideal position to be in. Also pay attention to who constitutes the preferred shareholders. For the purpose of these votes, it is the majority of all preferred. Or can a single investor with a small stake have veto rights? Founders have been held hostage by small investors with outsized veto power, and vice versa. Insist on a meaningful threshold, typically a majority or majority in interest of preferred. And one more thing, try to get an expiration date or sunset clause on protective provisions. They often make sense in early stages when the investor is taking real risk. With the business of as the business is starting to attain clear product market fit, with a market willing and able to pay, these make less and less sense. And as the company is becoming more established, then they are no longer needed. So, be warned and be careful. Next up, we've got drag-along rights. Love them or hate them, they are in almost every term sheet, and they're one of the most powerful and misunderstood clauses in the document. Here's how they work. A drag-along provision says that if a majority of shareholders, typically a combination of pref shares and ordinary shares, agree to sell the company, they can drag along the remaining shareholders, forcing them to sell too on the same terms. The idea is to prevent a small minority of shareholders from blocking a sale that the majority support. Imagine if 90% of your shareholders want to accept an acquisition offer. Without a drag along, that 10% minority can hold out, demanding more money, better terms, or just creating chaos. Drag along solves that. For the VC, drag along is an exit mechanism. It ensures that when they are ready to sell, when they've found a buyer at a price that they like, they can actually complete the transaction without being held hostage by a handful of early employees or angel investors with common shares. For the entrepreneur, the risk is asymmetric, and it depends heavily on the trigger for the drag along. If the trigger is a majority of preferred, meaning investors can drag along without your consent, you would find yourself forced into a sale you didn't want at a price you do not want or hate. This is particularly dangerous in a down scenario. Say the company hasn't hit its targets and the investor decides, yes, let me rather just cut my losses and bounce. If a drag-along trigger is investor-controlled, the founder might have no choice but to go along with a deal that returns capital to investors but leaves ordinary shareholders with very little. My advice for founders and entrepreneurs alike is to push for a drag-along trigger that requires both a majority of preferred and a majority of ordinary shares, or at least a majority of board composition, including founder-appointed directors. In that way, a sale can only be forced with your involvement as the entrepreneur and investor. Also, look carefully what protections are baked in. Any drag along worth agreeing to should specify that dragged shareholders receive the same price per share and the same terms as the majority. Otherwise, you could be dragged into a deal that treats you worse than the investors themselves. Since we've made quick work of that, now let's talk about the instrument itself. Because understanding what the investor is actually buying matters enormously. In most VC deals, investors don't buy ordinary shares. They buy convertible preferred shares, a special class of equity that sits above ordinary in almost every way, but can be converted into ordinary shares under certain circumstances. As indicated earlier, I think I will have to do a whole episode on shares and shareholding, but we'll do this at a later stage to get to the bottom of all of this. But for now, what we need to understand is that these preferred part means they get preferential treatment. They are first in line on liquidation, and they often have voting rights attached to them. And they hold all the protective provisions as we have discussed. The convertible part means that they can switch to ordinary shares, typically at the investor's election or automatically upon IPO or initial public offering. Convertible pref shares are very common when working with grant and early stage investors. The instrument is aimed at allowing the investor teeth in the event things go belly up, like protection mechanism. This is because ordinary shares constitute actual ownership of the business. If things go well, an investor would like to convert because the company is acquired at a high enough valuation, with the pro rata share of common stock or ordinary shares being worth more than their liquidation preference. Non-participating preference shares face exactly this choice: take the preference or convert. The conversion ratio is usually 1-to-1. One preferred share converts to one ordinary share, but it can be adjusted by anti-dilution provisions. So now, anti-dilution is a huge topic on its own, but in a short version, if the company raises money in a future round at a lower valuation than the current round, which normally is called a down round, anti-dilution provisions adjust for the conversion price to protect the investor from being hurt by that dilution. There are two main types: full ratchet and weighted average. Full ratchet, this is the more aggressive. The conversion price resets to the new lower price as if the investor had invested at that price all along. This can be brutal for founders because it massively increases the number of ordinary shares the investor would receive upon conversion, diluting founders significantly. On the other hand, we also have the weighted average, which many may see as a much fairer dilution type. The conversion price adjusts based on a formula that accounts for both the new price and the volume of shares issued at that price. In many ways, it softens the blow. Now, for the investor, an anti-dilution protection is fair game. If they invest $50 million invest at a $50 million valuation, and the next round prices the company at $20 million valuation, then it has lost value. Anti-dilution is their hedge against such capital losses. And then for the entrepreneur, what is acceptable is a weighted average. Resist full ratchet with everything you have. Full ratchet anti-dilution is in a down round can effectively transfer control of the company from the founders to the investors overnight, not through vote, but through sheer mathematics. Also, watch out for related concepts such as option pool shuffle. Usually, before investors calculate your pre-money valuation, they may require you to set aside a percentage, let's say 10 to 15% of the company for an employee option pool. If the pool is carved out of pre-money valuation rather than post-money, you, the founder, are the one taking the dilution, not the investor. Living in a country like ours, with incredible historic and economic imbalances, we are a great advocate for employee option pools. I hope we all got that. Now we're going to move over to redemption rights. Redemption rights give investors the option, usually after a certain period, typically 5 to 7 years, to demand that the company buy back their shares at the original purchase price, sometimes with some interest. Stated differently, if the company hasn't reached a meaningful liquidity event, let's say gone public or been acquired by year 7, then the investor can turn around and say, I want my money back. And then some of the honor of holding those shares for the 7 years, and they get a little bit on top. So, for the investor, this is a time-limiting mechanism. VC funds have a lifespan, typically 10 years, with the possibility of extension of 2 one-year terms, so up to 12 years. If a portfolio company is still private and illiquid after 7 years, the fund manager needs a way to return capital to their own investors. Redemption rights give them a contractual mechanism to do that. Within the South African context, this is when the VC fund would typically look for an exit strategy through either acquisition or trade sale to maybe a later stage VC or to a competitor organization. However, for the entrepreneur, this brings forth a problem. Most startups don't have the cash sitting around to redeem millions of rands, dollars, or renminbis in preferred shares on demand. At best, this becomes a negotiation point where both parties find a middle ground to be able to ensure the venture continues on, uninterrupted. At worst, the entrepreneur will be forced to make a plan and enact a liquidity event or find some form of replacement capital for current investors. And luckily, there are now more and more funds that actually look at replacement capital in order to cater to such an eventuality. Oh my goodness, we have covered a lot. Let's now try and bring it all together. Reading a term sheet isn't just about understanding each clause in isolation. It's about understanding how they interact. Liquidation preferences plus participating preferred plus drag along controlled by investors is a combination that can leave entrepreneurs with almost nothing in a moderate exit. Protective provisions plus a narrow drag along trigger plus full ratchet anti-dilution can mean entrepreneurs lose operational control without ever losing a vote. The good news is that term sheets are negotiable. Everything on that page is a starting position, not a final answer. That's our deep dive in term sheets. If this felt like a lot, it is. But you know enough to ask the right questions. And that's often the most powerful place to start off from. If you found this useful, share it with a fellow founder who's heading into their first raise, or a seasoned founder who can benefit from actually revisiting these terms and understanding how they all stack together to form the whole term sheet. It might be the most useful 30 minutes they spend this week if they actually do that. Until next time, read everything, sign nothing you don't understand, and more importantly, negotiate like your company depends on it, because it does. Thanks for joining me for yet another journey of discovery. I am Yongama Square. Till next time, keep the course strong.